Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in.
Today on the podcast, we have Mr. Litan Yahav. Litan is a Navy veteran and tech founder who exited his last startup 8 years ago, became a full-time alternative investor where he has exposure to private equity, real estate, startups, and crypto. Through his passion for generating wealth and passive income, he ended up building a new startup called Vyzer for automating the management and control of these types of alternative investments and keeping passive investing passive. Hi, Litan. Welcome to the show.
Hey, Joe. It's amazing to be here. Thanks for having me.
Thank you for joining us.
Choosing the right insurance coverage for multifamily properties isn't that complicated if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz and we'll start the conversation.
Could you start by telling our audience a little bit more about yourself and what you do?
Yeah. So I'm 40, almost one, can't believe it, 41 years old, married, I have 3 kids, born in the States, but I moved to Israel when I was a kid, live in Israel now, so far, far away, and served in the Navy, as you mentioned, for 6 years in Israel. And after that, went to school. And after school, founded a startup in a very weird industry, in the diamond and jewelry industry. We won't dive into that too much, but anyway, it was a crazy industry that went well. And we sold the company about 8 years ago, made some money, and just started to invest. A few single family homes in the US, and then those moved at the same time also into multifamily deals as passive investors, LPs, with friends and friends of friends. And that started to grow and became a mess, and decided to build a new startup. So that's like a quick rundown of my background, but we can dive into any aspect of that you think would be interesting.
That sounds pretty cool. But Litan, I'm not going to let you get away from not talking about your stint within the diamond and jewelry industry, because it is a very interesting story. So, but I want to ask you this, because I know that I've heard you speak about it on other people's podcasts, and you mentioned that you built the software. In fact, why don't you just give us a quick 2-minute overview of what you built there?
Right. Yeah. So in Israel, like I mentioned, so I got out of the Navy. I was 24 years old, and that's when I went to school. Most Israelis go to college, 22 and upwards. And so we're older college students. And then my last year of school was in this entrepreneurship program funded by Sam Zell. And looking for businesses to build, we found ourselves in the diamond industry, in a very archaic, old-fashioned industry where things happen in a way that no one could imagine happening, from trading to manufacturing to online sales. Just everything is totally upside down. And we found an opportunity there to make the whole trading cycle of diamonds more efficient. Because instead of shipping them around the world to be inspected, so just to give you some insights into the industry itself, right? Diamonds are mined throughout the world in different locations, South Africa, Russia, Canada, just different places, all over Africa, to be honest. And then most of them reach India, and they're cut and polished in India and then traded from there to New York, to Singapore, around the world. And so the trade of diamonds between those locations is just totally archaic. Like, people would fly around with these diamonds, they'd ship with couriers to a store on the other side of the world. That store would look at the diamond and say, hey, no, I don't want this, and then send it back. And so we decided, why don't we just build a machine and you put a diamond in, it creates a 3D image that you can send the image instead of shipping the diamond. And that's what we did. And we were great timing, great team, great technology, and it worked. And we disrupted the whole way diamonds are traded using our technology. So now almost every diamond in the world goes through Segoma, which is my previous company's name, and is photographed, uploaded, and almost every diamond you'll see online is through our tech.
So the specific thing I want to pick up on here is that you had exited, right? You sold this company to, I think you said that for the it was, and help me out with this if I'm getting this wrong, but you were saying that you have sold it to a company and only they had the exclusive rights to use this platform, right? So that made me think about whether do you ever think about that you could have been the Blue Nile if you had kept this?
All right, so yeah, I can dive into that part of the story. So
Yeah,
when we started, our hypothesis was that a diamond is traded 5 times before it reaches a consumer. And that trading process that's where the money is. That's where people would value seeing a diamond on their computer screen, super high resolution, seeing everything in it, and could decide based on an image whether to buy or not. We never imagined that any consumer would buy a diamond seeing it so big on your screens, because it's scary to see something like all the imperfections and the exact color. It's like no one would buy a diamond based on that. And so when we set out and we raised money, one of the companies we raised money from asked for exclusivity, and they paid for that exclusivity exponentially as we went forward in the consumer, in the B2C industry. So we could not display our merchandise, our images to consumers. That was the exclusivity. And then when we grew and that became the standard, that's sort of when it hit us. Yeah, I mean, we could not have become the Blue Nile because it's a totally different business. Our business was photographing diamonds, to be as simple as that. That was our business. Our business was not e-commerce.
Gotcha.
And so we focus on the photographing, and e-commerce is a totally different business.
Gotcha.
And that's what we focused on. And we might have been bigger there and made more money there.
Yeah.
If we didn't give exclusivity as well. But I mean, I don't even think about that. I don't regret anything.
Yeah. Yeah, no, that's awesome. I mean, that it kind of takes me back to, one of the first startups I ever invested in many years ago was in digital media. And, we were in the angel round or the friends and family round. And, I think they have bigger investors come in, and we could have exited some of our capital, in the Series A. And we could have made a quick 10x after 2 years, and I got greedy. So I was like, no, I'm holding out for the 100x, right? But eventually our capital, the company ran into cash crunch. And so I ended up with almost nothing. So it was a good learning experience. It's all about risk. It's all about risk management, right? Our world of investing is all about risk management. Yeah, it's crazy because when you invest, venture capital or startups, it's high risk, or people say high risk, high reward. There's definitely high risk. So with that, maybe we could transition to the other side of the spectrum, which is how you got involved, investing in real estate, and then also syndications.
Right. So we had this windfall. Some money. It wasn't tens of millions of dollars, but it was enough. It was enough to sort of think, all right, what do I do now? Right. And sort of we're young and well connected. And obviously we were approached by a lot of financial advisors and private banks and people who wanted to manage our money. And we said, screw that, we can do this on our own. So we just, new people who did real estate. We really weren't interested in real estate abroad. We didn't know that we wanted to be passive from the get-go. And as many people, I think, made the same mistake, thinking that buying a rental property, it doesn't matter if it's managed by someone else. It is not, it's not fully passive. It's That's more right. passive than actively managing it. And I always like to say there's a spectrum of passiveness in investing, right? And real estate investing, the spectrum is so broad, people just don't have no idea, right? If I go and I buy a condo in Miami to Airbnb on my own, that is a lot more active than going to buy a long-term rental property in Brooklyn. And that's more active than a long-term rental property that's managed in Atlanta. Each of these things, there's levels of activeness and passiveness. I also think, obviously it comes on account of risk reward, right? The more active you are, the higher chances of you really making more money, but it's also more riskier and also more headache. For me, if it's not exponentially bigger, both of those, it's not worth it for me to be active because my passion is to build stuff. So anyway, so we bought 2 single family homes in Ohio through a guy we knew. And these were like managed by a property management company. We never saw it. It was like full turnkey solution. And at the same time, we had another friend who does syndications that was raising money. We said, yeah, let's put some money in there as well. And then we had these 2 investments, and me and my co-founder did all this together. And so we had these 2 single family homes in Ohio, and we had this syndication investment that we did. And the single family homes in Ohio just became a shit show. It was just a mess, like constant phone calls, emails from the property management firm, and tenants coming in and going out, and municipalities reaching out and asking for stuff. It was just a mess. And at the same time, we were getting this cash flow from the syndication, like, oh, shit, like it's doing better cash flow. We're not doing anything. Why the hell would we want to do any of these if we can do that? It took us 4 years to get rid of those single family homes. And we lost money a little. We didn't lose a lot, but we lost some money there. And we've since then only invested in syndications, right? And just like fell in love with the passiveness. But it's not peanuts. Like there's still work that goes into that, but the work is up front. The work goes into, for us, finding people you can trust, finding good operators or GPs to invest with. And then when the deal comes to the table, it's deciding if it works or not works. Doesn't work for me. That's sort of how we got into syndications. And we did this in the US, did it in Europe, and just got our appetite for it just went up and up.
Yeah, I can certainly resonate with all the things that you mentioned. As a active investor in small multifamily and single family for many years, it's literally just it becomes a secondary job, and then it's like the more real estate you have, the more work it becomes, and then just I wish I would have learned about syndications much sooner. I didn't get into until late 2016. I just wish I had known about it, years before that. So yeah, I definitely share the same sentiment with you.
But it is very important to emphasize, right? I don't think it's right or wrong. I just think that if it's your mindset to do that as a full-time or part-time job, and then generate exponential returns as opposed to syndications, that's fine. My mindset was I want to be passive and build companies, and so it didn't fit my mindset, because like, all right, like let's say syndications generate 15% IRR, 16% IRR, whatever. If you go on your own and you start to flip homes, which is like super active, you can do a lot more than that, right? You can do like 100% per year, and it's a full-time job, right? But it's higher risk, and so I'm not saying it's wrong. I'm just saying for our mindset, it didn't match what we were looking for.
Yeah, I guess it just depends what you're looking for.
Right.
So Litan, I know that. Actually, before we talk about the economy, I know you've invested in a lot of deals, so you have a lot of experience, and also as an entrepreneur, yourself, you can see all the pros and cons and everything. Maybe can you kind of just describe to us like what your favorite operator looks like?
Yeah, so this might sound really stupid, but for me, it needs to be someone I can trust that will never screw me over. That's like rule number one. And it sounds like a simple rule, but it's super hard to vet, especially like in these times when you're hearing about all these stories about these GPs that stole money from LPs and operators that go under. I mean, listen, if the shit hits the fan and things happen, it's not. I don't know. I don't think it's the operator. I mean, it could be the operator's fault, but I don't. So anyway, rule number one for me is finding people I can trust. That's the most important aspect of it. And then once you're down to that, it's sort of all right. Now, when deals come on the table, before that, like now, I've done, I think, like 35 deals until now, as an LP. And so like now, as part of the vetting process is sort of finding those people. I've joined a bunch of these like mastermind groups, and and listen to a lot of podcasts and read a lot and talk with a lot of people. And I feel like pretty well connected and in a place where it's easier now to vet people. And also questions that I ask before I go into any type of relationship is like when you talk with a new operator, there are questions that I like to ask to see where they are, how they think, before the deal, specific deal comes on the table. And if you want, I can dive into those questions, or we can dive into different aspects of the vetting process.
How about, yeah, so how about this, Litan? Why don't you give the audience a few examples of like major red flags?
Yeah, so I think when people are getting started and they're not always aware about the person who's in front of them and their position within this thing that's called the syndication. And this is things that I only learned down the road. But like one of the things I ask always, and I think I asked you before this, like, what's your position in this syndication? Because there's the person or organization that actually goes and sources the deal and vets it and does that. And then there might be a different organization that goes and fundraises for the deal. And there might be a different organization that does other aspects of the deal. So it's like, it's super important to understand the person you're speaking with, what their position is. And now a super red flag is that when you talk with someone and they don't disclose that they're the capital raiser. And when you start to ask them, like, all right, like, are you sourcing this deal, or are you raising some money for someone else? And it's fine. I mean, yeah, it's not bad to find a funder, a capital raiser who's raising for someone else's deal, because if you trust that person, then they have the connections and access to good deals. They'll do the vetting process. But if they don't tell you that that's a situation, that's a huge red flag for me, right? If I found out after the fact, can you hear me all right?
Yeah, everything's good.
If I find out after the fact that this person just like essentially just didn't disclose the true relationship, that's a red flag, the biggest one. And then there's smaller red flags, right? So like, for example, I always like to ask specific, like in multifamily value add type deals, but not only, like what happens in a refinance event? How do you guys structure those events? And this is a question that I never asked when I started. And I only learned it when I experienced these refinance events as an LP and was surprised by the outcome and what is now happening as an LP in my position within the deal. And each operator or GP has a different approach to this. And it's okay for them to have different approaches, but it's important for them to think about this going in. And I'll give you an example of what I mean. So if I invested $100,000 into a multifamily value add type deal, pretty straightforward, right? You get some sort of cash on cash return, let's just say preferred return, which is also cash on cash, like 6-7% annual, distributed every quarter. And then 5, 6, 7 years later, there's an exit, and then there's a split, 70-30 split on the profit. You have a catch up, whatever, if you didn't reach the pref. And that's sort of like, I mean, I don't know what you guys, what your deals look like, but that's sort of like the plain vanilla of these like types of deals, right?
Sure.
What happens if a year in, there's a refinance event and I get $90,000 back? I only have 10 grand in the deal at the moment. What do the distributions look like? Like that's 6-7%. Am I supposed to continue getting that? Is it based on the remaining 10,000? Do we already hit the hurdle where there's a split above that? Like what happens? And these are questions I always ask operators that I just get them to meet, because I want to see how what their answer is, if they have one. And this is not a big red flag, but sometimes they'll be super confident about the answer, but then I'll ask them, are you sure? That doesn't make any sense. And I have to look into that. And 95% of the time they'll get back to me and say, it's not as I said, it's different. There's so you get a sense for people when you talk to them and ask those questions, and how they respond, and if they're bullshitting you or not bullshitting you. So that's also for me a smaller red flag. And then I won't call these red flags, but these are things that I look for in operators, right? For like size of the operator, how many deals they do a year, if they're a fund or if they're a single deal type operation. But that's different, I guess.
Yeah, no, those are all really good tips, and I certainly share the same sentiment as you do. So as we get closer to the end of our show, I want to kind of pick your brains a little bit more about you're obviously a successful business person, and love to just kind of get your outlook for what you think might be happening with the economy, maybe the investment landscape over the next couple of years, and where are you looking for opportunities?
So those are all great questions, and none of us are prophets. There is a sense that the economy is sort of towards the end of this bad run, just because inflation is sort of getting a little more stable. I wouldn't say getting better, but a little more stable. That might mean that interest rates might go down. Like the Fed might lower the rates. I mean, I don't know. But with all that said and done, I think that there's the ripple effect hasn't really affected the real estate market to the extent where you see people like fire selling because they need the cash. People are getting fired because of different reasons. Unemployment will go up. I think that people aren't taking. I mean, you hear about AI and its effect on tech and all that, and people getting let loose. I think in the next upcoming year, this is going to grow exponentially because AI is just going to get better, and people have no clue about the extent of where this will go. I think it's going to be crazy. Like we're not even at the tip of the iceberg. I think, and that will affect everyone. But whenever there's a downturn, there's a lot of opportunities, and so there's a lot of distressed properties coming into the market now. And so there's a lot of opportunity I think that good operators and GPs will find. And so that's one thing I look at. Number two is there are a lot of operators that over the past 10 years, it was a very easy market. And a lot of GPs, I think the vast majority of GPs that exist today, sort of, or maybe all of them because of the Jobs Act, I don't know, but were founded in the past 10 years.
Sure.
During an amazing run of real estate and interest rates. And now when interest rates went up and the business model is just like, you can throw them out the door. This is when you'll see the good operators survive and the bad ones flush out. It starts with them not distributing cash, and then they start capital calling for more money because everything's just more difficult, and then they just go flop. And so that's dangerous. And so it's really important to vet operators and understand sort of the loan to asset value, make sure they're not taking too many assessments that rates will go down, that the deal is really good. I don't think I will not, I mean, I don't know about refining, but I don't take a refinance into account at all in this market. Personally, I was supposed to have 5 exits this year of properties, like investments that I made. None of them are going to exit, and it's fine. I mean, I understand it. It's just like when you plan your cash flow, it's like one of those things you need to take into account, right? Also, like for us, like me and my co, like we have a bunch of these different investments, and just understanding where everything is and tracking it all just became a mess, right? And so it's really important to stay on top of that type of stuff as well. Especially in these uncertain times. So I don't know where the market's going. I do think there's going to be a lot of distressed properties and a lot of opportunities. I think, and this sounds stupid, right? But only the good operators will survive this downturn. Yeah.
Yeah, I mean, this is like, no, it really does. I mean, I think you gave a very accurate assessment of what's going on. This is like typical business cycle where when you have an attractive business and when you're in a very attractive industry, especially with the Fed printing so much money, you have all this money chasing good or not so good assets. Well, actually, I shouldn't say that. Assets are good. It's what you do to it to make them good or bad, right? Mm-hmm. And so you go and then you attract all this capital and maybe unsophisticated money, and then you have froth, and then eventually, now the Fed's pulling the liquidity away. So, the people who are not good operators are going to get exposed, and then, all the froth is going to get cleaned out. Just this is a very typical, we go through these ups and downs, call them business cycle, if you will. So, okay, Litan, if you had $100,000 to invest right now, what would you do with it?
I find a good operator to invest with.
I love that. Because people are, some people are sticking in U.S. Treasuries earning 4.5%, and there's nothing wrong with that either. But I love that.
That's a good point. I think that, yeah, obviously that's a really good excuse for not investing now. It's not a bad excuse, but yeah, because if you can get at zero risk or almost zero risk, like 6%, it needs to be extremely beneficial to take the risk and put it elsewhere.
Yeah.
Right. That's life. And so, but if you find distressed properties, that means you buy them at a really, really good price. And there's a lot of things you can do with it. The upside should be a lot more than that. Right. So again, I don't go into I personally look at deals. If there's a if it's a value add type deal, like 15%, 16% minimum IRR projection is what I look for now. And even more than that, I'm even looking for higher risk stuff like development deals that, have the potential for 30% IRR, 35% IRR, because it's higher risk. And there are syndicators that do those types of deals. I'm invested with a few of them. And that's sort of higher risk, higher return, shorter time. And so, yeah, there's so many asset classes out there and so many opportunities. It's always the question, like, who do you want to invest with, and doesn't match your strategy in current times.
I'm glad you, it seems like we keep coming back to this point. It's like, regardless of the asset class or, it really comes down to investing with people that you can trust, right? That's really what it comes down to.
It's so hard.
Yeah.
That's the hardest part of it. And that's why so many people don't do it, because they don't want to put in the work of finding people they can trust. They don't want to take that risk. They want to, right?
Yeah.
Well,
Litan, before we get closer to the end of our show, as the CEO and co-founder of Vyzer, I want to give you the opportunity to kind of share with us like what you're doing there. And yeah, if you want to just go ahead and tell us what you're doing with Vyzer.
Yeah. So Vyzer basically, so when we like 3 years ago, our spreadsheets began to break, and all these deals I get, and these are good problems to have, right? But I get emails from operators like, this is this quarter distribution, and this is the K1. And I'm like, shit, when did I invest with these guys? How much money did I invest? Is this what I expect? And so we built these crazy spreadsheets and just spend a lot of time and work maintaining them, and then decides like, we want to be passive. Let's do something that keeps us passive. And so we built ourselves that piece of software to automate everything for us. I want to get an email from you and then forward it to Vyzer. I want to link in all my bank accounts, and then for Vyzer to let me know when a transaction comes in and match it to the investment. And then also pull in my brokerage accounts and my startup investments in crypto and everything in one place. And that's what Vyzer does, basically. After we did that, a bunch of friends wanted as well. And then we decided, well, there's a bunch of people like us around the world, specifically in the US. And that's when we founded this new startup about 2.5 years ago, that helps people like us basically track, manage, automate their wealth. That's what Vyzer's about, basically. I got rid of my spreadsheets. A bunch of people around us have as well. We only use Vyzer.
That's really awesome. Yeah, we're definitely familiar with the product, and we certainly share that with our audience and our investors. So thank you for doing that. That's awesome. I'm going to ask you a few more, just some lighthearted questions, just so the audience can get to know you a little bit better on a personal level.
Sure.
Can you recommend a favorite podcast, a book, a movie, or a documentary, and all of the above?
So if I had to choose one podcast around our world, I'd say Left Field Investors. I really like what Jim Pfeiffer and his team have been doing with Left Field Investors.
Nice.
A book, I always recommend this, and I just can't recommend it more. It's Never Split the Difference by Chris Voss, which is just negotiation skills are so important for everything we do in our life. Like even morning, waking up and getting my kids ready for school is just a constant negotiation, deal making, everything. And what other types of recommendations?
Oh yeah, how about a movie or a documentary?
A documentary. That's hard. I mean, I there's something that I remember that just like is something that was mind blowing for me. I don't know how true it is or isn't, but it was just mind blowing. There's a documentary called Seaspiracy on Netflix. I'll give one that's hard and one that's lighter, right? So Seaspiracy is all around the plastics and fishing and how it's ruining the world, basically, and the fact that plastic pollution. The fact that we're all taught that straws and plastic bottles and bags are what are polluting the world, but 50% of the pollution in the oceans are from fishery. And when you look at the companies that are funding the plastic anti-bottle and straw movements, the funding is coming from fishing companies. And the reason is they want you to move your focus to that and not look at the fishing. Anyway, that was mind-blowing for me. The second one, which is more fun, it's also a documentary. I love the Formula One Fight for Survival. Like, me and my wife are addicted to every season of that. So that's like two sides of the spectrum of documentaries.
No, I love this kind of question because you don't know what you don't know, and it's like everybody's passionate or interested about something, and it's just like, oh, I didn't even think about that. So I love that. Believe me, the answers that you give I think they're very impactful. So
yeah,
thank you.
Those are great. Those are great questions. I've never been asked that, and I've been on a bunch of podcasts, so I love it.
Thank you, Litan. Okay, just two more if it's okay. I know it's getting late over there. What advice would you give to your younger self?
Don't stress out as much. Things will be all right.
Love that. I love that.
Yeah.
And what is the one question that I should have asked you, but I didn't?
I guess, what values are most important for you in your kids? I think that's like, for me, I always ask myself that, right? Like, what do I want to instill in my kids? I have 3 young kids. And I think that, look, they're the future. And if you'd ask me that, I guess what I'd answer, and maybe that would be your next question, or it wouldn't. I don't have to answer it.
No, I love these kind of questions because, many of these podcasts, focus on investing and making money and strategies and whatnot, insights. And that's all great, right? But at the end of the day, it's like, what's life about, right? We want to make an impact. We want to live a meaningful life. And then through these personal questions, I feel like we can learn a lot, or we can learn a lot from what we don't know. And so thank you for that.
Right.
Well, hey, Litan, I've taken up so much of your time and it's getting late over there. And I just want to thank you for providing your valuable insights and wisdom for our listeners. And we appreciate what you're doing with Vyzer to help investors manage and gain access to more alternative investments. We support anyone providing the opportunities and tools and education to help regular people become savvy investors in the alternative investment world. Lastly, before we let you go, where can listeners find you?
So I'm pretty active on social media, so Facebook, LinkedIn, Twitter. You can also head over to our website, Vyzer, VYZER.co, or litan@vyzer.co. Love to speak with investors, passive investors, answer any questions I can. Yeah.
Awesome. This is Joe Feng with Break of Day Capital signing off. We will be back next week with another informative episode on the Real Estate Investor Podcast.
Thanks a lot.
To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.